Hey everybody, hope you're doing great today. In this video I'm going to talk about commercial mortgage-backed securities, CMBS, basically what they are and what kind of issues they're facing in the present as well as the near future and what kind of impact that will have on the economy. Anytime anybody wants to borrow money to purchase commercial real estate, they can go to a commercial mortgage lender, apply for a loan, put down 20, 30%, whatever number that the lender requires, and get the rest of the amount they need to purchase the building financed. So with a fixed residential mortgage, whether it's a 30-year or a 15-year, typically those are fixed rate. What that means is once you sign on the dotted line to get that mortgage, you close on the loan, you close on the house, that interest rate is fixed for the life of that loan. So that interest rate is fixed for 30 years, let's say. So for instance, somebody bought a house last year when the mortgage rates were a little lower. They were in the 3-4%. They locked in at 3%. As long as they don't sell that house, as long as they don't refinance that mortgage, they are locked in on that 3% mortgage for a fixed term of 30 years. Now there are adjustable rate mortgages that residential buyers can use. Typically that's not common these days in the United States. Other countries it's a different story, but in the United States a majority of the loans are fixed rate. With adjustable rate mortgages you can get a little lower rates, but there is the risk that the rates will go up when the rate unlocks. With commercial real estate, there is no fixed rate option that long. Basically, a commercial mortgage cannot be fixed for more than 10 years at most, depending on the lender. A lot of these commercial real estate investors are taking out 2-3 year fixed rates, commercial mortgages, basically where they sign up for the mortgage, they close on it, and their interest rate is locked in for a couple of years. And this is because with commercial mortgages, there's not the government backing, there's not the programs out there like your VHA, your FHA, your Fannie Mae, Freddie Mac, those types of entities or programs that will purchase these mortgages and basically guarantee them for the length of the mortgage. So being lower risk with residential, it's not an investment, it's something somebody's living in. They want to try and maintain that in good shape. They want to keep up on their mortgage so they don't get kicked out of their residence. So typically they see lower risk with that and they're able to charge a fixed rate mortgage for 30 years. So commercial real estate does not have that government backing generally. There are SBA loans that one can get. Those are different, they're limited. For most of the commercial purchases, they're non-SBA loans. They're your typical loans that you get from a commercial lender and they're fixed for 2 years, 5 years, 7 years, all depending on the lender. So they may have fixed interest for a couple of years. Their terms are much shorter than your typical residential real estate. With residential, you can get max 30, sometimes even 40 years now. With a commercial, you're looking at no more than 25 years. A lot of times it's going to be 10 to 15 years. And even though it might be a 10-year mortgage term on your commercial mortgage, what a lot of lenders will do is they will amortize it over 25 years, and that means the payments are lower. Basically, you're dividing your monthly payments over 25 years versus 10 years. But then what happens at 10 years is you have this huge balloon payment that's due. And in most situations, the investor, what they'll do is they will refinance that, pay off that balloon note, refinance on whatever the new rate is, and then go on from there. So the problem we're going to be getting into today with commercial mortgages is the fact that a lot of these mortgages only have a fixed rate for 2 years, 3 years at most. So a couple years ago when rates were lower, these investors purchased their property, they locked in low rates that only last 2-3 years. They have to refinance today, they have to refinance within a year. Rates are much higher now. The current federal funds rate is sitting in the mid-4s. In the past it was close to 0, and that had a large impact on the interest rates that commercial lenders were providing for commercial investors wanting to borrow. So rates were much lower a couple of years ago, and that had a large impact on the interest rates that were charged to commercial investors. They were much lower a couple of years ago. Today they're much higher. So when those investors have to refinance, the problem is going to become that they have a much higher rate. Their numbers were underwritten using a lower rate, and the rent and the cap rates, whatever they were underwriting on, now suddenly changes. They're facing a much higher interest rate payment, and that actually can hurt their cash flow. They might end up going negative cash flow, in which case it doesn't make sense to invest in a property with negative cash flow. So there might be a lot of forced sellers. There might be a lot of borrowers just walking away, jingle mail, turning in the keys and saying, you take the building. There have already been cases of that. especially with large numbers where some purchasers of large office buildings, which with the work from home policies still going on these days, a lot of employees are not going downtown, they're not using their offices, they're working from home. So a lot of these investors who purchase these big buildings are now simply saying, okay, we're not making our money. So there have been a couple of large investors who simply walked away, gave the lender the keys to the building, so to speak, and said, you take over the building, we're not paying on our loan anymore. The big issue will become with commercial mortgage-backed securities. And basically what this is a lot of lenders don't want to hold the mortgages on their books unless they know it's a very strong client. What they will do is they will package these commercial mortgages up into a security, and then they will sell those securities to insurance companies, pension companies, investment funds, hedge funds, basically anybody looking to earn a return on their investment. They can buy a large chunk of these commercial-backed mortgage securities and then take the income from that and use that for their investment purposes. Especially organizations like pension companies and insurance companies, they need more conservative investments since they like to keep a steady cash flow. They're not going for high risk. In the past, when there wasn't much pressure on the commercial mortgage-backed securities, they earned a steady rate of return that allowed them to keep their auditors happy. A lot of commercial investors are now being forced to refinance at a higher rate. If they can't afford that higher rate, many of them are simply going to walk away from that investment. Let's take a look in detail a little more at the CMBS. This page is from Investopedia. Basically, a CMBS are fixed income investment products that are backed by mortgages on commercial properties rather than residential real estate. So yes, there are residential real estate backed securities, and investors do purchase those. It notes here, CMBS can provide liquidity to real estate investors and commercial real estate lenders alike. Basically, as long as they're packaged up into one security, it's easier to sell that security to other entities if they need to get liquidity. Versus having an individual mortgage, it's not something you can go to the borrower and say, pay me back right now, I need that money. Otherwise, if you were to do that, you're likely going to force that commercial investor into default, and that's going to cause the value of your loan to go to zero, basically. As they note here on Investopedia, the underlying securities of the CMBS may include a number of commercial mortgages with varying terms, varying values, different property types. For example, they mention multifamily dwellings and commercial real estate. Typically, when you're in the 5 units or more in multifamily dwellings, they're considered commercial. You have to use a commercial mortgage to purchase those. Anything 2 to 4, you can do a residential mortgage. So some of these CMBS have office buildings, they have multifamily buildings, they have strip malls, they have industrial. It could be a variety of different types of buildings that are being financed, and that puts a lot more risk on the owner of that CMBS depending on the default rates on a certain asset class. So let's say in particular a CMBS has 20% office space. A lot of office space now is being underutilized due to work from home. As those investors who own those office space decide, hey, it's not worth my time, I don't want to invest anymore, I don't want to refinance because it's going to be much higher rate, I'm not getting the cash flow, I'm going to walk away, that's going to hurt those underlying CMBS. They note here that the CMBS is similar to a bond, so you go and purchase a bond, whether a corporate bond or a government bond, you're getting certain payments over time, and then as that mortgage is either refinanced or paid off, then those principal payments also go to the owner of that CMBS. So this chart here is from the St. Louis Fed. They keep a lot of good data, and this chart details the amount in billions of US dollars of commercial real estate loans. As you can see here, post-Great Financial Crisis that we had in the 2009, 2010, 11 timeframe, commercial loan amount went down, and then it went up quite a bit. Up until March 15th, the number was going up. And now it's turned around, especially with the federal funds rate being higher now, it's forcing a lot of borrowers to cut back on their loans. So either they're walking away from the property or they need to refinance. They're doing wrap loans. They're bringing in cash to the table to reduce the value of their loan in order to meet the requirements of the mortgage. This chart here covers commercial and industrial loans. So there could be loans for industry. Sometimes those loans do get packaged into the CMBS. But as you can see, there was a peak here in May 13, 2020, went down. Then when rates were down for a number of years, then borrowers came back in. And then again, we peaked here in January. It looks like the January 2023 timeframe, and then the numbers have started to go down again. So here's our federal funds rate. This is the rate that the Federal Reserve charges for other banks to borrow. And the rates, as you can see, from 2009 through 2015 were pretty low. They went up, and then starting in 2019 the rates were dropped again, and 2020 through 2022 the rates were down close to zero again. And then due to inflation raging out of control, the rates had to go up, and they have jumped quite a bit over here. We can see the rates are now currently in the 4.65% range. So just to give an example of what the rates were in the past, here's an article from February 19th, 2021, Value Penguin, which is associated with Lending Tree. Here are your average mortgage rates back in 2021. Traditional bank loan, 5 to 7%. Construction loan, 4 3/4 to 9 3/4. Insurance loans starting in almost the 3% to 5%. Fannie Mae, Freddie Mac apartment loans starting in the low 3%. Bridge loans starting in 4%. Now let's take a look at today's rates. This is stacksource.com, their commercial mortgage lender, and we can see here the rates. Interest rates, the Freddie Mac, Fannie Mae start at the low 5%. Regional banks, low 5%. Life insurance companies, low 5%. Debt funds, 8%. So the numbers have gone up a couple percent over here. So in the past, where the numbers might have made sense, where you could borrow for less, get a decent cash flow, if your cash flow hasn't changed, but your rates have gone up, that's going to cause some problems for your borrowing ability. You either have to bring more cash to the table, you have to try and increase your rents if you're able to. With a lot of asset classes, even things like strip malls, office space, the ability to extract more rent is more difficult because there's fewer tenants using office space due to the work from home. And things like strip malls or even full-on malls are fading now. They're failing basically because the trend is going away from indoor malls to either destination shopping locations like downtown areas with small little shops, or small little strip malls. If it's a small strip mall in a city that has nothing else, then those generally do pretty well because the local populace is relying on those strip malls to provide them groceries, pizza, liquor store, craft store, pet services, whatever you have close by, those are needed and those are in demand. But things like large malls are going away due to Walmart and Amazon type companies where online shopping is the key. Online shopping is the way. A lot of people want to get things delivered to their doors, so even things like DoorDash, Instacart, they're being delivered from a central warehouse, from a central store, and it's brought to a person's house. So that in turn is putting pressure on certain strip malls. That in turn is putting pressure on certain shopping centers. There are certain shopping centers, certain plazas that are still doing well depending on their location. So location is key. They're usually located in city centers or in easy to access areas close to the freeways where people want to go, they want to congregate. They've got a lot of restaurants. You got a lot of food options for groceries. There's also entertainment, whether there be movie theaters, concert halls, and then you also have shopping there as well. Downtowns are now seeing a revitalization. So in the past where the downtowns faded away, you had large malls popping up. People wanted to congregate to the malls. Now it's going reverse again. People don't want to go to malls. They want to go to these downtown areas, hang out, walk the downtown area, check out a restaurant, check out a bar, catch a movie, and then drive to home to wherever they live. Here's an article from yahoo.com, Yahoo Finance. Commercial real estate is in trouble. A banking crisis will make it worse. This is from March 24th, 2023. They note here, this year roughly $270 billion in commercial mortgages held by banks are set to expire, and $1.4 trillion over the next 5 years. What they mean is either their rate locks will expire or the term of the mortgages is going to end and they will need to refinance. So refinancing in the face of higher interest rates is going to put a lot of pressure on these borrowers. So here's an article from Seeking Alpha, dated March 4th, 2023. Delinquencies on commercial real estate loans rise sharply in quarter four. That would be quarter four of 2022. So loans overdue for 30 days and those in non-accrual status accounted for 0.65% of commercial real estate loans at the end of Q4. That's up from 0.58%. Here's an article from April 18th, 2023. Brookfield defaults on $161 million in debt for office buildings. So they defaulted on their $161 million mortgage for a dozen office buildings, mostly around the DC area, primarily driven by vacancies. So the loan's been transferred to a special servicer who is working with the borrower to execute a pre-negotiation agreement and determine the best path forward. So this is putting pressure on the borrowers. The borrowers can't make their payments. They need to work out a deal with the lenders. That's going to put pressure on the lenders. They have a lot of loans that are coming due and they can't get that money back. That's going to put pressure on the banks. So overall, this is going to put a lot of pressure on the economy. As these loans start defaulting, that's going to put pressure on the banks. That'll affect the bank stock values. That'll also impact the ability of the bank to lend out money to others who want to borrow, whether it be residential or commercial, especially in these particular banks, these smaller regional banks that keep the commercial real estate mortgages on their books. They will be facing more pressure as compared to banks who package off their commercial mortgages into a security and sell them to pension funds or insurance companies. So with the higher interest rates, commercial real estate investors are going to try and pump rents. My opinion is they will not be able to follow through with that, especially in the office space with lack of demand from tenants. The ability to get more rents is not possible. Even on the strip mall industrial space, if our economy heads into a recession, that's going to put further pressure on rents. That's going to put further pressure on businesses that were already struggling with higher interest rates, businesses that were set up during a time period when interest rates were low and they were able to eke out a profit. Now that those interest rates are higher, that's going to put further pressure on their business model. And if they're not able to make a profit, those businesses are going to shut their doors. If this video was helpful for you, please hit that like button so that lets me know. And that also helps spread this video to others who might be interested in it as well. Thank you for watching, and I will see you in the next video.